The Australian Banking Association yesterday announced that the banks will be extending loan deferrals for another 4 months where required. That's on top of the existing 6-month deferrals that are being granted to home borrowers and business borrowers. Now, this development is as expected. So just to remind you of our view, what we've been saying is that come the end of September, if hardship levels remain elevated, then our view was that bank and government support measures will be extended. So we've now got confirmation that those bank support measures will be extended if required. And I also think we're starting to get unofficial confirmation that government support measures will also be extended if required. So we've seen Scott Morrison and Frydenberg and the likes hinting at extending JobKeeper and some of the other support measures in light of the renewed lockdown in Victoria. So that remains our base case at this stage. And what that means is that that helps the banks contain asset quality, at least in the near term, because what it means is that these loan deferrals will continue to be treated as performing loans. And that can be the case right through to up to March next year. A very important element is that the Australian Banking Association announcement was followed up by APRA's announcement regarding the capital relief. So that, like I said, that capital relief will be extended for these loan deferrals for the additional 4 months. But more importantly, what APRA has said is that the banks can restructure loans up to 31 March without those restructured loans being deemed to be non-performing. So normally if a loan is restructured where the terms are modified or renegotiated, and that can even include extending the term of the loan by a year or two, normally that would be treated as a non-performing loan and it comes with adverse capital ramifications. But what we're seeing is that APRA has said that loans can be restructured or modified up to 31 March and still be treated as performing loans. So the capital requirement there will not increase and they will not be treated as arrears and what have you. So what these announcements mean is that asset quality metrics will remain contained at least up to March next year. And even beyond March, I think what the banks will do is they'll look at borrowers and they'll think, okay, if we're getting towards March next year, the unemployment rate is still elevated. The banks will have to make a call. They'll think, okay, look, we think this borrower we're looking at, a particular borrower, is viable over the long term. They might be out of a job for the moment, but if the unemployment rate starts to come down over the next year or two, we can see this borrower getting back into the labour force and be able to service the loan. And so what the banks might do is say, okay, look, we'll extend their loan period for a year or two and put him on interest-only payments for in the meantime. And so what this means is that if it takes a year or two longer for the unemployment rate to come back down to where it was, in the meantime, asset quality won't necessarily blow out. It buys the banks a little bit more time and it buys the borrowers some more time for things to normalise. So I hope that's making sense. So on the asset quality front, our views are unchanged, and what we've been saying there and continue to say is that consensus is looking way too, I think, pessimistic on the bad debt charge forecast. And what's in the share prices is even more pessimistic than consensus. So from that perspective, I think the major bank share prices, with the exception of CBA, offering very good value right now, Westpac being the clear preferred there. And the last point I'll quickly make is on dividends. What all this does mean is that the fact that we're seeing APRA and the Australian Banking Association tell us well in advance that come the end of September there is the option to extend loan deferrals by further 4 months. What that tells us is that the regulators feel that there is still a lot of uncertainty about the outlook, particularly asset quality. I think particularly what APRA and the RBA would be thinking about from a bank asset quality perspective is what happens to hardship percentages going forward and what happens to the unemployment rate. And both those fronts are pretty uncertain right now. And I think what that means is that APRA will keep their dividend restrictions in place for the moment. And so I continue to expect that CBA will not declare a final dividend in August, and that ANZ and Westpac will not declare deferred interim dividends in August. So to summarise that, I don't think any bank dividends will be declared in August. Now, I'm not saying that definitively. I'm saying that on the basis of probabilities. I think on the basis of probabilities, the banks won't be declaring dividends in August. So just need to be able to stomach that. But other than that, I think there's some pretty good value on offer outside of CBA.